Investors have a wide array of investment choices. Besides trading individual stocks, which offers a share of ownership in a specific company, investors can select from mutual funds and exchange-traded funds, which are ETFs, that give them access to virtually every corner of the financial market. ETFs are collections of stocks, bonds, or other investments that are traded on an exchange. You want your investments to perform well. Each investment instrument brings its own unique set of benefits and disadvantages. With so many different choices, many investors find it hard to decide what exactly to invest in when choosing between stocks and ETFs. It is important to know the differences and nuances of each to make an educated choice that aligns with your investment strategy. Today we're going to discuss ETFs versus stocks. We're going to talk about what they are. We're going to talk about how they're structured. We're going to talk about the risks of stocks versus ETFs. And we're going to talk about the similarities. And then I'm going to sum it all up. Let's get ready to rumble. Hello, and welcome to Project Dividend, where we help you navigate the journey of becoming a dividend investor, beginning with the basics and transitioning into a well-informed and knowledgeable dividend investor. Along the journey, we encourage you to interact with us through your questions and comments. And if you've not done so before, please subscribe, like, and share this video. The content is not intended to be financial advice. Seek a duly licensed professional for financial advice. Now that we have that out of the way, let's get started. What are the differences between ETFs and stocks? Well, let's talk about it. Well, you will commonly hear both stocks and ETFs called assets and securities. While these terms might seem confusing, they really are not. An asset is anything of value that you might own, and a security is an asset that you can trade either in whole or in part. Stocks, also known as equities, are shares of ownership issued by companies to raise funding. A share of stock gives you a portion of voting ownership in a company. Stocks priced below $5 per share are often referred to as penny stocks. Trading in penny stocks to some is risky and considered speculative. Common stocks allow owners to vote during shareholder meetings and may pay a portion of the company profits to the investor, called dividends. Stocks primarily trade on stock exchanges like the New York Stock Exchange or the NASDAQ. The value of a stock share will change depending on the company, their financial performance and structure, the economy, the industry they are in, and many other factors. Exchange-traded funds, or ETFs, on the other hand, are types of professionally managed and pooled investment. The ETF managers will buy stocks, commodities, bonds, and other securities, creating what is generally referred to as a basket of funds. The funds within the basket are called holdings. Fund managers then sell the shares of the holdings to investors. While opening the fund, the managers will buy or sell portions of the holdings to keep the fund aligned with any stated investment goal. For example, an ETF may follow a particular stock index or industry sector, buying only assets listed on the index to put into the fund. For an example, you might have a fund with only oil stocks, or you can have real estate, or you can have technology. Both ETF and stock values will change or move throughout the trading day. If you're a long-term investor, these movements should not be concerning. The value of an ETF share will change throughout the day based on the same factors as stocks. ETFs will usually pay a portion of earnings to investors after deducting the expenses for professional management. You can find ETFs that focus on a single industry, country, currency, bond, and more. The risks of ETFs versus stocks. Investments can be volatile. Many factors affect investments. Company executive turnover, supply problems, and changes in demand are only a few. Investments also come with inflation risks, which is a loss of value due to the decrease of value in the dollar. For instance, you might receive a $1.50 distribution from a stock issuer one year and then watch the rate of inflation rise over the next year. The $1.50 that you receive next year is able to purchase less than the previous year, making it less valuable. The volatility of a stock is measured using metrics called beta. This is a comparative measurement used to indicate the volatility of a stock based on the market it belongs to. Risks can be measured and communicated using a stock's beta. A beta of 1 indicates its volatility is equal to the market. Less than 1 indicates volatility less than that of the market, while greater than 1 indicates volatility higher than that of the market. It's slightly less risky because it's a mini portfolio or basket of investments. An ETF is slightly less risky because it's a mini portfolio or basket of investments. It is somewhat diversified, but it really depends on what's in the actual ETF. If you were to invest in an oil and gas ETF, you would assume nearly the same risk as purchasing an individual stock. However, ETFs might overcome this by spreading their holdings out around the globe, holding natural gas as well as oil stocks, or diversifying the basket in other manners with a hedging strategy. Let's talk about liquidity. Liquidity refers to how easy it is to convert stock or ETF holdings into cash or another investment. With stocks, it will depend on the corporation issuing the shares. If they are recognized, financially stable, high-quality stocks, also known as blue chip stocks, you will have no problem trading shares. On the other hand, penny stocks may take weeks or days to trade, if you can trade them at all. ETFs are nearly as liquid as stocks. For the most part, again, it will depend on the quality of the products the ETF carries in its basket. The fund's trading volume will also impact liquidity. All right, let's talk about some similarities between the ETFs and the stocks. Besides being traded on the open market, ETFs and stocks do have some similarities. The Internal Revenue Service will assess taxes on the dividend income from both stocks and ETFs. You will also pay capital gains tax if you made a profit when you sell the stock or ETFs. Capital gains are any increase above what you paid for the security. You can deduct your losses up to a point which will help offset the total value that capital gains are calculated against. Dividends are taxed as income unless they meet the criteria for qualified dividends, in which case they are taxed as capital gains. You can create a stream of income from your portfolio of stocks that pay a regular dividend. Many companies share profits with shareholders. Some even have been proven to increase their dividend year after year. These stocks are known as dividend aristocrats. ETFs can also create income streams with their basket of holdings. Often a fund will invest a portion of its funds into bonds, which are corporate and government debt instruments. They will disperse the income received from these investments to shareholders after deducting expenses. Let's talk about the bottom line. ETFs come with risks, just like stocks. While they tend to be seen as safer investments, some may offer better than average gains, while others may not. It often depends on the sector or industry that the fund tracks and which stocks are in the fund. Stocks can and often do exhibit more volatility, depending on the economy, global situations, and the situation of the company that issued the stock. ETFs and stocks are similar in that they both can be high, moderate, or low risk investments based on the assets placed within the fund and the risk of those assets. Your personal tolerance for risk can be a big factor in deciding which might be the better fit for you. Both have fees and are taxed, and both provide income streams. Every investment choice should be made based on the risk involved for the individual and their investment goals and strategies. Which is right for one investor may not be right for another. Keep these basic differences and similarities in mind as you research your investments. Okay, so is it better to buy high dividend ETFs or high dividend stock? If your sole consideration is income, then it may be better to buy stable stocks with histories of raising dividends. ETFs change expense fees that eat into your income. However, high dividend ETFs may offer better price stability through diversification, so they may be a better fit for an investor who is concerned about reducing risk and preserving capital. So who wins, stocks or ETFs? Well, the answer is, if you're looking to create stable, consistent monthly income, it really doesn't matter. Dividend stocks and dividend ETFs, they basically work the same. It's a matter of your preference. Well, if you found value with the things that we're discussing, please subscribe, like, and share the video. Until next time. Hey, Dividend! I've got my eye on you.